Over the past couple of days, the markets in crypto have been pretty volatile. This is my trade history from Binance. Over the past few days, you can see that I've done a lot of selling. What does this mean? It means that even though the markets are volatile, there's always a way to make money in any position going long at spot. I'll show you the secret and I'll let you in on something that will change your trading life forever. Let's run the numbers. The crypto market over the past couple of days has really gone nowhere fast. But that doesn't stop us from making money. The key to consistent returns is to understand price volatility, understand the Tier 1, the Tier 2 and the Tier 3 charts. That's how I make my returns. The first thing that I want to show you, we buy on red and sell on green. You can see these green arrows, these are all buys. And you can see the red arrows, they're all sells. You can buy and sell consistently on any specific crypto. In this case, we're looking at Solana. You can see that as price was coming down, I was buying. When it hit my targeted rate of return, I was selling. And I was accumulating to distribute in this up wave. Now I'm starting to accumulate in this down wave, but I make sure that I take profits along the way. I never ever sell at a loss. Let's pop across and look at Doge. You can see all of these sells, accumulation and sells. I want to show you something very specific because it's really important. You can see I was buying on this spike down, buying on this spike down. I love negative spikes. When people are getting out of the market, I'm getting into the market. Don't forget, all of these involve no leverage. I don't short. I simply go long at spot. As I was coming into the market, everybody was fleeing from it, and you can see all of these sales through here. One thing to always bear in mind, this particular BORSOG strategy, which is what you can see right here, this is buy on red. It does take a lot of unwiring of your central nervous system, because when you see price come down like this, the most natural thing to do is to run, is to sell. I want you to think about it completely differently. When price goes like this, I want you to think how you can buy, how you can run into the burning building. Because when you run into the burning building, what happens? You pick up everything cheap. When it comes as consumers, we don't buy things when they're double the price, but we do so for some insane reason inside financial markets. Now, there's another very big benefit to this buy on red, sell on green, or BORSOG strategy. As price is coming up, you're de-risking your portfolio and your positions, only to scale back in when there are retracements and scale back out when the risks start increasing. This is an absolute game changer, but you cannot do any of this without a knowledge of CTKS structure, and that's my secret sauce. Before I get into that, I want to show you some trades on ADA. Again, buy on red. These capitulation spikes, we absolutely love them. As a community, we're BORSOGs. We buy on red, which is the BOR, and we sell on green, which is the SOG. And hopefully this visually indicates how BORSOG works. You can have periods of time when you accumulate and periods of time when you sell out. You're actually putting yourself on the right side of the percentage when you scale in, and when you scale out, you're putting yourself on the right side of the risk curve. But again, I could not do any of this if I didn't understand CTKS structure, so let's have a look into that. Having been inside financial markets for coming up to 4 decades, one thing that you will learn is that you need to have your rules. Rule 240 is especially important. CTKS structure first, but what exactly is that? That's how I make my money. I could not have made any of those profits if I did not understand CTKS structure. CTKS structure is where smart money buys and sells on the Tier 1 charts, the Tier 2 charts and the Tier 3 charts. When you look across all of these different tiers with CTKS structural levels inside, you can do what I do. and I'm going to give you an understanding of what CTKS structure looks like. When we look at total crypto market cap, and you may say, Ken, why are you looking at total crypto market cap? I just want to understand Doge and ADA and XRP and all of those things. This is the first key. Tier 1, Tier 2 and Tier 3 charts are all intercorrelated and interconnected. If you don't look at the right charts, you cannot use the structure effectively. For example, the thing that we see here on total crypto market cap. And what is total crypto market cap? This is the total value of the crypto market as a whole, second by second, literally. It trades 24 hours a day, 7 days a week. It never sleeps. When we look back to the past, not the past, but the previous bull run cycle, we can see that we overcame resistance and things turned a bit positive, and then we had COVID. If we didn't have COVID, we would have took off. A lot of people use this particular outlying, statistically insignificant point and say the charts rely on the whole world closing down, and that's going to repeat. Statistically, that is not true. These particular events happen probabilistically once every 100 years plus. This is not likely to occur in the next 3 or 4 years, and that's something to bear in mind. When you see people using statistically insignificant points on a chart, you need to be aware of it. That's one thing that I know that I look for in my charts. This is exactly why we need CTKS structure, and I'll explain it. The first thing you need to know is, where is the market basically headed? You can see as we get across different levels of resistance, the bull market starts to take off. What are we seeing currently? We're getting above different levels of resistance. The bull market is going to start going. We are just literally at the start of it. Does that mean only up? Of course it doesn't. Price moves in a wave, and we want the waves, because when price moves down, we get on the right side of the percentage. Without this core concept of market direction, you will be wrong-footed because you'll be scared to get in or to get out. For example, when we look at Doge, we can see Doge in the previous bull market. Wow, it just rocketed, and we can see it's overcoming a wide variety of different resistance levels. Doge and the entire crypto space is heading for a bull market. Does that mean it can't retrace? Of course it can retrace, and those retracements can seem absolutely terrifying, as we see here. But the concept is, we're on the right side of momentum. That is, we expect any retracement to be met with buy demand. Statistical significance is incredibly important to understand. You can see my Bitcoin chart. It has a very specific look. If you ever look at a Bitcoin chart like this, and some influencer shows you this and tries to say, hey, this is where the action is happening, run like hell away from those people. Ken, why do you say that? Because I used to lecture first and second year statistics. I can tell you absolutely that a logarithmic chart must be used on Bitcoin, especially over extended periods of time. Anybody who looks like this is trying to scare you or trying to FOMO you into a position. The absolute change in difference between here and here is immaterial to the change in difference between here and here. The concept with logarithmic charts, you're looking at equal percentage movements. This is something that really scares me and frightens me about the crypto community. Too many people they use arithmetic charts, non-log, and as a result, they terrify people, because people would just look at it and say, oh my God, this thing is all over the place. But when you look at an exponential asset class on an exponential scale, wow, things become more sensible. This is an absolute critical thing to do. How do you do that? On TradingView, you just come down to the L and just click that, and that creates a logarithmic scale. Arithmetic scales are wildly misleading. If you're doing your markups based on arithmetic scales, you're going to burn your money. Absolutely. Take it from a 40-year veteran. And how do you tell if it's on arithmetic or on log? If it's on arithmetic, you will see very fixed absolute values between. And when you're on logarithmic, It's fixed percentage values, so it doesn't look like it has that much of a structure. It could look like things are kind of grinding together and then tearing themselves apart in terms of a consistent scale. This is a consistent scale. You can see it's always 4,000, but this logarithmic chart is all over the place. It's sometimes more than 4,000, sometimes it's less, sometimes it's something else. You can see, especially as you go down to the lower figures, you want to focus down here. If the difference in change between levels is inconsistent, you're on a logarithmic chart. This is vital to understand. If I didn't know this, I couldn't do the trades that I do. Now you know the overall direction, you know the positivity or negativity biasing. You're also not messing up like so many people do and looking at a statistically exponential asset class on an arithmetic basis, which is a statistical no-no. That is an absolute wrong thing to do. Mathematicians know this, but people who are not mathematicians have no idea why that is the case. But take it from me, it's the case. If you want to make returns like this, you have to know the difference between arithmetic scale and logarithmic scale. It's vital to understand. Another very important thing to cover off is diversification. Here we're looking at XRP. XRP, you can see this buy on red, sell on green. Buy on red, sell on green. Wow, that was just a machine gun attack. And that happened in like half an hour. And you can see this is the way the crypto market works. It's very forgiving, but it always works inside structure. You now have an overall viewpoint. We've looked at total crypto market cap and Bitcoin. We also looked at Doge. Bitcoin and total are tier 1 charts. They're the engine of financial markets globally. These are two out of the engine. Bitcoin and total crypto market cap are very good indicators of risk on or risk off activity. We know that Bitcoin and total crypto market cap are getting ready to start their bull run. We've confirmed that with Doge, which is a tier 3 chart. Of course, the best thing that you can do is to confirm it with all the different cryptos. Which brings me to the next very important thing to understand, that is diversification. I make sure inside the crypto market that I hold positions in each and every crypto that is marked up with CTKS structure. I hold positions inside Solana, inside Doge, ADA, XRP, BNB, Litecoin, Bitcoin Cash, Ethereum, and Bitcoin itself. You can't actually trade total crypto market cap. It just gives you a direction, but it's very important to know what that direction is. This is the way that you diversify. Now, how do you know how much money to put into each specific one? I would suggest that you put equal amounts in, understanding that something like Solana can move very, very fast in relativity to Bitcoin and Ethereum. Ethereum can move in greater percent amounts than Bitcoin. From time to time, Bitcoin moves more than Ethereum, which is a bit of a worry, especially when we get flights to safety. But if you look at something like Solana and Doge, XRP, they can move really, really big amounts. It's also good to understand that Litecoin and Bitcoin Cash can be utterly explosive. That means they may come down for a while, but when they just rock and roll, oh my goodness, they blow the roof off. You must be aware of the personalities of the cryptos that you're involved with. When it comes to spreading your money around and diversifying, one thing that I do, I focus on all of these marked up with the CTKS structure, because as you'll see very shortly, if you don't have that, you will not know what you're doing. But I spread the money into these different buckets. Even when it comes to things like Bitcoin, you can consistently sell and de-risk your position. Buy back, de-risk, buy back, de-risk, buy back, de-risk. You get the idea. But you must know that CTKS structure, or you'll be guessing where the real resistance and real support levels are inside the market. I think what we might do is to look at CTKS structure on Bitcoin. A lot of people would not have bought as Bitcoin was coming down here. They simply wouldn't have done it. But I'm going to show you why that was an especially good trade. if you knew CTKS structure. But if you didn't know, you would be bailing on Bitcoin, no question about it, exactly at the time it would turn around and pump up. I'm going to zoom into this specific area. Just remember, that's the area that Bitcoin was selling down. And I'm going to show you where the CTKS structure is. These are structural support levels, and they're drawn out across more than 5,100 days worth of data. As a core developer of technical analysis, I know all the tricks and the tips when it comes to TA. CTKS structure is without question the most powerful TA method you can ever employ, because it gives forward guidance on where price could go. When I was lecturing first and second year statistics, one of the things that I always told my students, an average, and you'll see averages used all the time in technical analysis inside financial markets. If you see an average, like a lot of people talk about the 20-day, the 50-day, the 100-day, and the 200-day moving average, they're really good to give you an idea as to the current trend, but they look backwards. The problem is this: if you're in an exponential asset class, averages can't cope with exponential price movement. Averages are built for arithmetic scale, not logarithmic scale, and every scale that you will see here is a logarithmic scale. When averages are built in, you will see that price does come down to it, but it's looking past, it's looking back. Averages cannot look forwards. That's just against their mathematical construction. However, when you look at CTKS structure, and these are the exact levels that I bought at, where Bitcoin was coming down, I set a reasonable rate of return based on the market's analysis, or based on my analysis of what Bitcoin can do. And you could see Bitcoin was selling through there on my trade history. This is something to just bear in mind. You're always seeking to do reasonable percentages. The whole concept of percentages is definitely another level, and we'll get into that in some other episode. What you need to know is if there's very strong structure underneath price, the probability of a bounce is very high. Probability is the basis, the foundation of statistical analysis. Averages come from statistical analysis. The whole market, the whole financial market system is built on statistics. We can see that Bitcoin is coming down right now into structural support. These structural support levels, of course, I buy them. When you see a line, I've already bought. That's what these lines represent. This is a bit of a window into how I trade, but it's a pretty good one. What do we see in Bitcoin at the moment? We can see that we're very close to a cut over in multiple areas. This means that there is an upward bias potentially on price. Therefore, where is the next structural resistance level where things could go awry? It's up here at this 39,255 mark. That means there's a lot of positive momentum that could come back into the crypto market. People won't be expecting this because they see that the S&P 500 and the Nasdaq are getting into overextended territory. But it's the weekend, and crypto doesn't care about the stock market on the weekend. What am I specifically looking out for? Let's just do a little bit of a line tool here. We could get a further dip, and I wouldn't expect it to go down too much further than that 36,211. We're forming a series of higher lows. This low is higher than that low. This is creating upward momentum, a potential breakout here. Just be aware that retail will be looking at this specific level around that 37,500 up to approximately that 37,892 mark. That could be where people start to encounter resistance. We would expect a pullback on a positive price path. We would expect a pullback, say, to that 37,400, and then up and down until we get up to that 39,255 mark. If we get negative price action, we would expect this particular level to hold, that 36,211. If it doesn't hold and it goes down further, That could be a short calling. Basically, the market is calling in the shorts to get liquidated because this is a ton of structural support. Remember, structural support is unlike any support that you will ever see. It is really, really strong. How else would I know how to buy these specific levels as price came down? I wouldn't, because I wouldn't have X-ray vision. If you look at the price chart like this and you say, oh, ooh la la, this thing is coming down, it's going to zero, it's going to 10,000, and people were calling it, I said, no, it's going to structural support and it's going to bounce, and that's exactly what it did. That is the power of actually marking up all of price history in excess of 5,100 days worth. And you can see this is not an academic pursuit. This is something that works. A lot of people say, Ken, what if the position moves against you? Okay, let's explore that. I have this position, this position, this position, this. Price moved against me. Oh no, what do I do? Well, retail would say I need to sell because I'm making a loss. But professionals say, no, I'm buying at structure and I'm selling at a reasonable rate of return. One that the market can handle. And this is a very important thing to understand. When you understand the CTKS method, you'll look at this, which is just literally buying at structure. When you look at this, you'll say, wow, what a gift. I'm so excited for this red momentum, this buying on red, this BORSOGing. I've done the BOR, now I'm going to do the SOG, sell on green. This does take time because you're putting your money on the line. I would suggest that you use a standard position size. If you've got X dollars and you want to trade across, say, 20 different positions, 20 different levels, and that's not a bad idea to do, and it's you will find out what's the ultimate for you to do over time. You can just divide X by 20 and it's pretty simple. If you make a standardized return on investment, you're going to find that you do incredibly well. But Ken, everybody's going for 100x, 200x. I can't just make a reasonable percent return. I've got to make 50 times my money back. And that's why people fail. When we look at something like Doge, you can buy it on the way up, but you don't want the risk curve to move against you. It's much better to buy it at structural levels and then sell it at a reasonable rate of return. And you can see here that I was scaling into Doge and I've already started scaling out because the rate of return has matched my requirement. A lot of people think that they can't invest or trade because they don't have enough money. For example, if you got a 5% return on $100 and you did it in a day, look at your annualized return on investment. Look at what $100 grows to. This is the great trading and investing myth, and I've seen it for so many years. Coming from a finance degree, I'm qualified in finance. I understand financial mathematics and I understand how the markets work. People are searching huge return on investments and huge absolute gains, never understanding that the annualized return on investment is the only thing that ever counted financially and statistically. We know the Bitcoin is bouncing from structural support. What is happening with total crypto market cap? It's come into a level of structural resistance, and this was really tough for it to get through. We almost got through it, but the market turned back. Where was it caught? It was caught at structural support lines. What is it doing right now? We can see it's having a cut over. If Bitcoin continues with its positive momentum, we would expect the total crypto market to come up to this 1.378 trillion. If that is the case, all of the tier 1, tier 2 and tier 3 crypto charts will be coming up as well. A lot of people make a big deal about Bitcoin and Bitcoin dominance. Those things are good to look at. Anything that gives you an edge is fantastic. Personally, I don't look at those things because I don't need to. I only understand the tier 1, the tier 2 and the tier 3 charts because that's all I need to understand. If total crypto market cap is falling below this particular 1.347 trillion, it's on its way down to 1.302 trillion. If Bitcoin is coming up from its structural support For example, we can see these higher lows being formed at the current time. We're getting close to breaking out because we've got so many cut overs in process. If we start to come up, we've got a fresh air gap, which means the price can move up very quickly and just shock and surprise everybody. A lot of people are going short on the crypto market exactly as it enters structural support. And the reason that the majority of people can't see structural support, they don't know how to create it. For example, if we just turn this indicator off and we were to just draw in as normal people would draw in something, they would just pick here, for example here, and they'd say, oh yeah, when we get below 36,087, it's all over. We're going to like this, we're going to go down. But when you look at structure, no, it's not the case. You would literally be selling into support. And of course, unfortunately, that's what a lot of retail does, but you don't want to do that. You want to know where the true support and true resistance levels are inside the market. And you can see there's not just one. There's a big myth that circulates around financial markets, and it's spread by influencers. There's just one level of resistance and there's one level of support. Nothing could be further from the truth. But it takes decades inside financial markets to understand these factors. If we're looking at something like Doge, as Bitcoin comes down, Bitcoin will push Doge down with it. As total comes down, it will be pushed down with it. You can see I've just put a buy in there on Doge because I'm buying on red. I'm getting the percentage to work for me. Typically what happens is that people make the percentage work against them. They buy as price goes up only to see price fall, and then they say, oh no, I got it wrong. I can't make a loss. This concept of not making a loss is very important if you're leveraged up. For example, if you're using any form of derivative product, you don't own what you're actually engaged in trading or investing in. It's a derivative. But if you're going long at spot, and that's all I do, I'm a specialist in going long at spot. That means I own it. When I put a position in here to buy Doge, I own that. I own this, I own this, I own this. And when I sell, I'm selling as well. I own that sale. I'm not paying daily fees and service fees and all sorts of fees. I'm just buying and selling. It's a much cheaper way to go. But a lot of people say, no, Ken, I need 100x leverage. That's good. 1% move against you, you've wiped out your position. That's the other thing that goes with 100x. What you're seeing inside this video, they're secrets. They're very few people that know about this. Our community definitely does, but we're a small community. Why are we small? Because I don't FOMO or FUD people. People want excitement. People want surprise, and people want 100x, never understanding that the journey towards 100x is not any way, shape or form what they think it is. And please note, the only things that I'm involved with are these things here, and you can always directly reach out and directly message me on Twitter at any time. I never manage anybody's money for them. The foundation of what I do here, I want you to be your own financial advisor. I want you to be able to look into the market and understand it and profit from it. When you know where the structural levels exist inside the Tier 1 charts, always start with them first, then look to the Tier 2 charts, and then finally the Tier 3 charts. Everything becomes much clearer. If something is strong, I would suggest paying a lot of attention to it. And always remember, you don't need to make big percentages to make big percentages. You want to focus only on the annualized return on investment. That's the key. Your absolute return is irrelevant. Just put it this way. Just say you go to the gym and you want a fantastic figure. The only way you get the fantastic figure is to do the repetitions of the exercises that will get you there. What you will find is a lot of people will say, oh, okay, you don't need to do anything and you can have a physique like this. That is rubbish. That never happens. You have to put in the hard work no matter what you do. Success is a slow thing that requires a lot of repetition of doing the right thing. When it comes to the market, you only want to turn those small percentages and have a huge, absolutely huge annualized return on investment. Always remember, your key to success is not the absolute return, it's not the absolute ROI, it is the annualized return on investment. If you don't have a strong annualized return on investment, you won't make it. I also want to show you something really interesting. If you look at a 10% return, and of course the other thing, it doesn't matter what you start with. You could start with 100, you could start with 50. If you're doing a good annualized return on investment, you'll grow that like crazy. The concept here, November the 18th, let's see if we did 10% in a day. Okay, that's a crazy annualized return on investment, out of this world. So let's not worry about that. Let's go to something more sensible. What about a 10% in a week? Whoa, didn't that drop? If you're making 10% in a week, that's not as good as making a lower percentage more frequently. Please keep this in mind. What about if that was not 10%? What about if it was 20%? Oh, that's getting better, isn't it? But what if that took 2 weeks? That's gone down a lot. What if it took a month? Ooh, it's gone down a lot. Would you be better off, say, getting a 2% return and doing it in about a day or two? Let's go back. That's better. Let's go back there. Okay, so what you're seeing is that big percentage of returns spread across time don't even equate to a small percentage turned over more regularly. I hope this helps you because it's a light bulb moment for the majority of people. When I do my returns, I make sure that they turn over a very high annualized return on investment. That's my focus. And one thing to note, I turn over a lot of my positions inside 24 hours. From here to up here is less than a day. In this video, I've talked about so many different things. I've talked about the idea of buying on red. I've talked about the idea of selling on green, de-risking your position. I've talked about annualized return on investment, understanding the market's direction, and especially understanding CTKS structure. If you don't understand that, you can easily sell at support and buy at resistance. You'll also find that the CTKS structure actually determines where the price waves go. If you're coming down into structural support, they're like safety nets. They'll get caught there and they will rebound up. How far they go up is another thing because it depends on structural resistance levels above. If you're on the right side of the percentage, you'll do incredibly well and nail those really large annualized return on investments. I hope this video has been of help to you, and if you have further questions you'd like to ask me, please reach out in the comments. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again tomorrow. Bye for now.